It's the siren song of the multifamily game. It draws you into the rocks and then it blows your ship up. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to talk about 5 lessons that really only experienced multifamily investors learn. And when I say only experienced investors learn, these are typically lessons that don't result from just purely making like a bad investment decision, paying too much for a property, buying in the wrong market. But these are typically lessons that are learned by investors as they've scaled their business, as they've grown their business. And these are usually a topic of discussion behind the scenes amongst higher level folks operating in this business. Again, some of them are probably going to be a little repetitive, but I think a lot of these are probably going to be enlightening and will resonate a lot with both new investors as it relates to, I don't want to make those mistakes, but also the more experienced folks who are on the verge of doing either more deals on an annual basis and really investing in the growth of their business, whether that's through marketing or some other kind of, they went full time, they quit their job, and now they're really chatting with a lot of brokers and they're thinking about scaling their business. Or folks that are looking to scale and do larger deals, maybe not a higher volume of deals, but just larger transactions on average. So what I'm going to do in this episode is just run through them. But before I do so, I mentioned this last week on the podcast, but I want to mention it again. Our newest investment offering is live, 72 units in Barrington/Lee, New Hampshire. Again, this is a direct to seller deal. We sourced this one through a mailer, buying it at a great basis, great sub-market. I mean, this is just a slam dunk deal offering compelling risk adjusted returns, minimal execution risk as we don't need to do a lot of construction, high in-place rent, so high in-place DSCR. A very simple business plan that we've executed on a number of deals over the last few years in New Hampshire. And the ownership group, the sponsorship group on this one is just more than experienced enough to handle the implementation of this business plan and the management of this asset. So we're really excited about this deal. Again, I've talked about it ad nauseum if you're on our email list, so you're probably familiar at this point. But if this is news to you, click the link in the show notes to be taken to the deal room for this one. This is a 506c syndication, accredited investors only, which is why I'm talking about it on the podcast. But you can find the PPM in there. You can find the webinar recording might be live by the time this episode is released. And you'll also find some other supporting information, such as the deck and some high-level information around this investment opportunity. If this is something that you want to learn more about, go ahead and schedule a call with me. There's going to be a link to do so, either A in the deck or B in the deal room, so you can find it in there. And I look forward to chatting with you about it. But let's get to this episode where I'm talking about 5 lessons that experienced multifamily investors find themselves learning. Number 1 is that scaling quickly is great. It's a great goal to have, but it makes it really hard to manage your cash as an investor. And something that I see oftentimes with investors who they just start pouring gas on the fire. Again, marketing, prospecting, they go full time, they make a hire, right? They hire somebody in to manage their properties in the PM role, or they hire like an operations manager to manage all of their third-party PMs, or they hire an underwriter, whatever. They make a hire in their business. They start spending money on marketing. More cash starts to go out the door. This creates a situation in which it can be challenging to predictably manage your cash given the volatile nature of running a multifamily investment business, where cash goes out the door in large quantities at various times throughout the year that are hard to predict. And it's also hard to predict when that money comes back. So what I mean by that is, if you're pursuing a lot of deals, you got to send a lot of money out for earnest money deposits. You have to start spending money on third-party reports, the inspections, the appraisals, the PCRs, the phase ones. You have to manage your ability to co-invest in your deals if you're raising capital, or just continue funding your deals if you're buying them yourselves as it relates to renovating the units and executing business plans. So forecasting where your cash is going becomes really challenging. And the downstream symptom of this is that investors that scale too quickly obviously are the ones that are more likely to get into trouble than somebody who's slowly growing their portfolio and making it easier to manage their cash. That we understand. But I think a lot of investors assume when they hear scaling quickly, they think, oh, this person's taking on a lot of debt. Or they're buying subpar deals, or the challenges come as it relates to the deals that they're buying and the capital structure surrounding those deals. And while that does happen regularly, I see just as often is the investors that are scaling quickly, they're still buying good deals and they're using the right debt. They're not over leveraging. They're using fixed rate debt from local banks at moderate rates, whatever. But they have a hard time managing their their entity level cash, right? The cash that they personally have as it relates to being able to pursue all of these deals. So let's take this, for example, right? If you're buying a $5 million deal, it's whatever. I mean, I guess that's small to some listening to this, big for others, but let's just use that as an example. You're probably going to have to put at least 2% down in earnest money to pursue that opportunity. 50 grand, 100 grand. You might have to put down 3%, 150 grand. Earnest money to just lock in that contract. You're probably going to have between 3 and 5 third-party reports you got to do for your lending. An appraisal, a PCR, a phase one. You're going to have to pay an inspector to go through there. You might have to pay, there may be some more specialized inspections required, maybe a septic inspection, maybe a well inspection if it's private utilities. You're probably spending 50 grand on third-party reports to pursue that deal. That's money that goes out the door and only comes back if you close it and you're reimbursed from all the capital you raised to close that transaction. Then you have your co-invest. If you're raising money, let's say you're raising $1.5 million to buy it, right? Whatever, a little bit more than 25%, 30% or so. All right. Well, now you have to go and invest $150K if you're investing 10% of the equity. So, and that's basically rolling your deposit into that. And then you're out of pocket all of the third-party reports. So if you're doing a few of those a year, money's going out regularly, and money doesn't come back that predictably unless you're charging a lot of fees on the deals that you do, or you're quickly turning deals. You're getting into deals and getting out of them as it relates to selling them and triggering your promote. But these are all very unpredictable events. You don't necessarily know when the next deal is coming, and when it does, you better have the money ready to pursue it. You don't really know how long it's going to take to implement a business plan. You do your best to project a year, 18 months, 2 years, whatever. A lot can change. It can take longer. It can take less time. It could take whatever. It's just hard to predict when that money's coming back, which is why sponsors charge fees to smooth out the variance of when the money is coming back into the business, because money is going out all the time. So again, why am I saying this? This is not something that you realize as you start to scale, but you must have a plan to manage this dynamic effectively as it relates to the deals that you pursue, as it relates to oftentimes making decisions to sell properties, either A, sell them, period. Maybe you're somebody who wants to permanently hold. Sometimes you got to sell to bring that money back. You got to take one step back to take 2 steps forward. Or when you refi, and you should always be selling and refining and securing lending, whatever it is, before you need it. Even if you have some money in the bank, you're looking at a property, you've kind of stabilized it, you've maxed out the value. Maybe you should consider selling that property now so that when that next deal comes up, you can pour your money in without stress into all of the required deposits, reports, etc. So if you take something actionable away from that point, it's just you want to be selling and turning over your capital before you need to do it, because when you do need to do it, then you're scrambling against the clock, and typically you're selling for a lower price than you should get, or you're refinancing at worse terms to condense your closing timeline. And I see that happen with a lot of investors. Number 2 is when you're buying a deal, you need to commit to your business plan. This is so common. It happens with us. It happened with us all the time in our business. And now we're trying to do a much better job of being very specific with how we approach this. You buy a deal where all the units are unrenovated and you have to renovate the units. And maybe there's some stuff that needs to be done on the exterior systems wise. The roof is going to need to be done in 5 to 7 years, but it doesn't need to be done today. The heating systems are going to need to be done in 5 to 7 years, but they don't need to be done today. You start turning over some of the units, you're renovating them, but you realize that you could probably raise the rent on the unrenovated units to the level that you projected for your renovated units. And you're thinking, all right, should I do that and then save the reno dollars? How should I think about this? But if that tenant were to leave, we can't rent it in its current condition. We're going to have to invest capital into turning it. So how do we think about this? The worst position to be in as a sponsor is you do a little bit of both, and then you execute your cash out refinance. You got money coming back in. That's great. But how do you think about returning capital to your investors? Do you return because the motivation is you want to turn as much as you can, because that makes your investors happy, and because that makes them more interested in investing in the next deal. Same thing goes with you as an owner, right? If you're just doing deals without investor capital, you renovate 5 out of the 10, you didn't do the roof, you did a couple of the heating systems, but a lot of that stuff's going to have to be done in the next couple of years. Money comes back via cash out refi, you throw it in the next deal. Your reserves are low for that other one. 2 of the tenants leave, you got to do the roof. Now you're scrambling for cash. It's typically a lot easier to commit to spending more before you execute whatever your capital event is, because what that does is allow you to manage your cash a lot more predictably in the long term. So, the challenge with doing so is that nobody wants to spend the money until they absolutely have to. And I think that makes sense implicitly, right? If the roof doesn't need to be done today and it could be done in 3 years, we want to do it in 3 years because the money's worth more today than it is in 3 years. And we just want to wait until it truly gets down to down to that last, we just want to take it all the way to the end of its lifespan, which makes sense. But by doing so, you're making a conscious trade-off to making it slightly harder to manage your cash between now and then. And this is something that this so frequently plagues multifamily sponsors who are raising money. And then the multifamily investor who's doing their own deals, maybe not working with investor capital, but it makes it harder to spread their cash around predictably because they have all these ticking time bombs from a CapEx standpoint on previous deals. Number 3 is there's a lack of clarity oftentimes with experienced multifamily investors as it relates to the type of investor or operator or sponsor that they want to be. And this is a continuum. Let's say, for one example, and I'm reading off of this because I have this down on my computer here. Do you want to raise a lot of money and do really big deals and grow a massive unit count and grow your assets under management? And let me define that. Do you want to raise 10, 15, $20 million in equity per deal by 150 plus, 200 plus unit institutional quality deals built in the last 20 years, minimal operational CapEx risk, et cetera? Okay, that's one decision you can make. Now, on the other end of the spectrum, do you want to buy deeply discounted smaller deals where you can turn your cash quickly, you can generate higher returns? You're probably going to need to do a higher volume of them to put out the same amount of capital that you can buying larger assets, which I just mentioned being on the other end of the spectrum. Or do you want to be in the middle? And a lot of people find themselves in the middle. There are reasons to be doing all of these different things. If you're buying larger assets, you're not buying discounted deals. You're buying fully marketed deals in an efficient marketplace with sophisticated sellers, buyers, and vendors. Sure, somebody will comment, no, I bought a 200 unit deal. Okay, great. You're the one exception. The other 99% are basically making levered bets on the macroeconomic situation within the geographical area. And maybe they're squeezing a little bit of excess returns out of their ability to operate, or they're buying at 200 a unit when the market's 210 or something like that. The game for the operators who are playing at that level is earning fees and just not losing money and generating moderate returns, which entices a lot of large check writers who are risk averse. And you can grow a massive platform off of that, but you're not going to rip out these massive returns that at least as consistently as you can on the other end of the spectrum, which is buying the 10, 20, 30 unit deals at 80% of value and being able to turn that capital and return it to investors in 12, 18, 24 months and generate higher percentage returns. And you can probably ask for a little bit of the promote as a sponsor if you do that. Maybe you can charge slightly more fees, but you're going to have to work 5 times as hard to put out the same amount of dollars and to grow the same size portfolio as you do on the larger end. Both have reasonings to do them, right? There are reasons to do both, but you have to sit down and define them in terms of as it relates to the type of investor you are, who your investor base is, and where your skill set is. What you don't want to be is somebody in the middle who's doing smaller deals that you're not getting great deals on and that you're not operating that well and you're earning moderate returns and you're kind of in the messy middle where you're buying that 50 unit deal at market. You're doing standard pref structures, an 8 pref 70-30 split. It's a $5 million deal and you don't have a lot of skin in the game because you didn't co-invest that much. And maybe you split the GP up and you've split in the fees and you're kind of in the middle. You'd rather buy killer smaller deals and take a larger chunk of equity in those, or just buy marketed deals at the higher end of the spectrum and raise capital at scale and earn bigger fees and just develop, just generate consistent LP returns, then be somewhere in the middle. So you should really define who you are and where you sit. And it doesn't have to be that way forever, but it just has to be where you are in the short term and how you understand and to make sure you understand where you're spending your time. Lesson number 4, one that I talk about, and a lot of people talk about this, but you save less money by hiring cheap vendors than what you make when you spend money on the best vendors. Spending less money in commission to hire the worst real estate agent, spending less money on construction costs to hire a lower quality general contractor, spending less money to hire a lesser quality property manager, all saves you money in the short term, costs you money in the long term. I actually don't even think I need to spend that much time on this, but this is something that every time I do it, I'm reminded, you idiot, you've already learned this lesson, you idiot. It's crazy how often somebody has to just get burnt doing this before they really learn it. And I think it's because the nature of so many investors is they want to seek value. They're seeking value. They're seeking a good deal. They want to save money. They want to maximize returns. When in reality, the best way to do that oftentimes is to spend more money to generate excess results. And I always use the property management company as an example for this. You're looking at two third-party PMs. Let's say you got a 20-unit asset that generates, I don't know, let's say $1,000 a unit. That's 20 grand a month, 240K a year. We're leaving vacancy out of this. Is that math right? Yeah, it's right. 240K a year. You have one PM who's going to charge you, I don't know, 6%. You have another one that's going to charge you 8% of collected rents, 2% difference. But the one that charges you 6 doesn't turn the units well, doesn't lease well. You have 10% vacancy for that property over the course of a year. All right, so that's $24,000 you're losing in revenue from the vacancy that's generated by this management company not being great. The other one that you charge that charges 8%, whatever I use as an example, 2% more. They're much more dialed. They can invest better in their staff. They hire better people, better systems, processes, et cetera. They run it at a 5% vacancy rate. So you're losing 12 grand a year. 2% of 240K is $4,800. So you're saving $4,800 to lose 12 grand. That is a trade that is being made by hundreds of thousands of investors. I mean, whatever the number is, that's being made by so many investors throughout the country because they cannot see over the immediate savings of a lower price or a lower management fee, et cetera. Do the math. You'd be surprised as to how much it costs you to work with bad vendors. Number 5, and this is the last one, and this is one that I think really, it takes a lot of experience to learn this. And this is something that only I'm really starting to learn now in a real way. I would rather pay up for more or for better located assets, which that sounds obvious. But specifically, the longer I'm in the business, the more yield I am willing to forego to buy properties in better locations. And it's really hard to quantify this, right? You can kind of do it by adjusting your vacancy rate from a C-class area to a B-class area, slightly adjusting your repairs and maintenance. And you can do this work in Excel. But it really takes some level of experience as it relates to owning both types of properties and underwriting both of them and comparing the actuals to the projections before you realize that is really hard to capture this difference in underwriting. The easy ways to do it, again, as I mentioned, adjust the vacancy rate. Maybe you're at 5 in the better area, 7 in the worse. You're at $1,500 per year in repairs and maintenance for the tougher area, $1,000 for the better. But what changes over time is the rent growth percentage. What changes over time is the ease of leasing a unit. What changes over time is your ability to command better property management pricing if you're working with a third party. A third party manager would rather earn 6% to manage a B-class located asset with tenants who are earning above the median income than 8% managing a C-class with tenants earning less than the median income. That's a better business proposition for a management company. And I would know because we run one where we manage third-party properties. And we know this. We do the math. It takes half as much work to manage a higher class property that's just one class higher than it does to manage one that's lower. So you earn more money by charging less as a management company. So you're achieving economies of scale there. And it's really hard for newer investors to realize this because so many investors are stuck in the Excel math phase of their business. Excel math tells you to pursue the C-class deals. It's the siren song of the multifamily game. It draws you into the rocks and then it blows your ship up or busts it up. One of the easiest ways to do this is to pay a little bit more than you feel is comfortable to buy a more well-located property in your market and to develop the experience of operating that asset and comparing those projections to your actuals comparatively to rougher properties. And I kind of feel like I'm on this journey myself within our business as it relates to, I am so much more aggressive as it relates to minimizing the margin of error within my underwriting on better located assets than I am with C-class stuff, because I know that it's almost impossible to accurately underwrite a C-class asset because the expenses you have to use to capture the actuals are so ridiculous. And they're so above what everybody else does that you're kind of forced to underwrite them similarly to others so that you don't bid yourself out of deals. And yes, you can underwrite a little bit more conservatively. What you realize is that it's really hard to capture the gap between the two types of properties. And again, the same thing goes for B versus A, for example, right? It's as you jump classes, the underwriting, one, you can be a little bit more exact because it's so much more predictable post-close in terms of the operations. But it's also really hard to quantify that until you've owned both because you don't have the perspective in which to make those comparisons. So Those are the 5 things that experienced multifamily investors typically learn after being in the game a long time. And a quick recap. Number 1, scaling quickly is great, but it makes it hard to manage your cash. So you need to sell and refi opportunities before you think you need to, far before you think you need to. Number 2, you should commit to your original business plan. You shouldn't half-ass your business plan. Commit to money going out the door early in a project so that you don't have to worry about ticking time bombs CapEx-wise later in the hold period. Number 3 is pick the type of investor that you want to be. Do you want to buy deals at market and deploy a lot of capital and grow a scalable enterprise? Do you want to spend a lot of time buying really meaty deals and have to do a higher volume, smaller deal approach? Or do you want to be in the middle? And again, I don't recommend being in the middle. Number 4, you save less when you hire cheap vendors than what you make when you hire better vendors. Number 5, the longer you're in this game, the more the more percentage returns, the more yields investors are willing to forego by buying more well-located assets, which is, again, that's a really hard one. That's probably the biggest lesson I've learned as I've been in this now for 8-9 years. That's the one that I've learned the most. But again, if you enjoyed this episode, if you took something away, if you learned something, please consider leaving the podcast a rating and review. And if you really want to be, if you really want to earn a special place in my heart, send this to somebody in your network, whether that's a business partner, whether that's an investor, whether that's a vendor, whoever. Send it to somebody if you think they're going to enjoy it, as it helps the show get noticed by more folks. And again, lastly, the last thing I'm going to mention here, if you want to check out our investment opportunity, our 72-unit deal in Barrington, New Hampshire, great submarket, direct-to-seller deal from a mailer, great basis, great business plan. Link in the show notes below. But again, thank you for listening, and I'll catch you guys on the next episode.